Good day, ladies and gentlemen. Welcome to Everyday Finance with Jay. My name is Jay. For the past couple weeks to 3 weeks, we recently just bought a house, and there's a lot of moving parts going on with the move and a lot of other stuff. That's why there hasn't been a video posted in the last couple weeks. And today, for this video, I'd like to discuss simple things you can do right now in order to prepare to take advantage of the current market, because as of right now, the market is still down from its all-time high in February. And if you haven't taken advantage of the all-time low in mid-March, do not worry. Don't have the sense of FOMO, fear of missing out, that you have missed it and that everything is going to go up from now and you can't take advantage of it anymore. The points I like to discuss today is how do you pick a stock and what do you focus on, and what are the professionals in the field of investing are what they're doing, and how to approach the next several months, potentially up to a year, if this coronavirus induced downturn continues. So how do you pick a stock? For beginners and investors who has been in this market for a long time, I would recommend to first start off looking at stocks that interest you. Because if you take a look at a stock, for example, that has to do with something that you're not personally interested in, maybe the first initial buzz you might continue and research it. But after a week, a month, several months, you might get bored and not really be that invested except for your money in that company, and you don't really feel anything special about it. So let's take a look at your personal life. For example, take a look at several different sectors of the market. For example, restaurants. If you like to eat at a particular restaurant, for example, that has great service for you in the past, Texas Roadhouse or Chipotle, McDonald's, or any type of restaurant, see if they're a public traded company, and then you can invest in their company. And then besides restaurants, it could be also if you like to travel and the resorts you go to, if they're run really well, maybe look into companies that own those resorts, or airlines. They're incredibly cheap right now, but that could continue for the near future or potentially up to a year or a couple years, because almost no one's traveling, and airline stocks is plummeting or hovering at a really low price. And other factors such as the medical field, for example, companies that make respirators, medical beds, or potential vaccine or cure for the coronavirus. There's a lot of companies out there right now researching that field. And if you're not really sure what type of company that will eventually develop the cure, you can look at an index funds, which is basically investing a little bit of money in that whole category. This way it takes the guessing out of the game. Or other places such as movie theaters. Eventually they will come back after the several previous recessions. Movie theaters tend to have done well compared to other sectors because people are tired of staying home all the time and they have extra income, so just go out to watch a movie. So now you have decided that some of the companies that you personally enjoy, and let's take a look at one that I personally enjoy, Chipotle. So first, take a look at their historical performance in the past day, week, month, 3 months, 6 months, a year, 3, 5, and 10 years. And identify their all-time high and their all-time low, and also the trend. What is the trend in the last several years? Is it going up or is it going down? And take a look at what the current price is. So identify how the current price is related to its all-time low and all-time high. And after that, take a look at the news, at what the company is doing going forward, how they're approaching this coronavirus, if they are anticipating layoffs, store closing, and how they're anticipating their profits. And if you want to take a look deeper at a company, you can take a look at their annual reports, 10K, or a quarterly report, a 10Q. Those reports are pages on pages long, and they have a lot of details, a lot of numbers, how much cash they have, how much debt they have, how many stores they have, what's their plan for the rest of the year. A lot of details that is good to read, but it's kind of dry reading. And the next step is take a look at how professionals in this field, how they're navigating the current market. Maybe we can learn a little bit about what they're doing and mimicking that for our own portfolio. One of the greatest investors of all times, one of my personal favorite, is Warren Buffett. And in the last week or two, Warren Buffett's company, Berkshire Hathaway, has published their first quarter earnings and a lot of details about what they have done. And basically, Warren Buffett had a Zoom meeting with shareholders, and he talked about how in the first quarter, Berkshire Hathaway has a lot of cash, over $100 billion of cash. Can you imagine that? 100 billion? It's 120 something billion. And they basically have not done a major purchase in the first quarter, even during the bottoming out. Some people may refer to mid-March. And what he said about that is that the current price in the past month or two has not been attractive enough for him to invest a good portion of his company's money in. So if he is that patient, even though April of 2020 has been one of the best months in the past many years, it grew, it was almost like a V-shaped drop return from its all-time low in mid-March. So if he's that patient and not worried about losing out on the potential gain because he knows that the current price is not attractive for him, maybe that you haven't missed out yet. And personally, for me, combining with what professionals are doing, I know myself, I tend to develop this feeling of FOMO, fear of missing out. And even though Warren Buffett is very patient with his over $100 billion, but he already has a lot of money. So he doesn't really, he has the resources to wait around. So what I will recommend is take a look at how you personally interact with money and how your relationship is, and also learn from professionals what they're doing, and then develop your own portfolio. So for my personal portfolio, what I do is let's say 100% of cash. Well, that's not assigned dollar value, let's use percentages, because you can in return use that percentage for your own portfolio. Even though Warren Buffett is waiting to make a giant purchase, I am leaning towards waiting a little bit too, because all of this happening right now is so sudden. The Volatility Index, which is a measure of how volatile, how quickly the market can move up or down, it can go either way, is really high right now. And knowing myself, developing the feeling of fear of missing out, I have deployed 25% of my cash holding. So right now, if the market tend to do a V-shaped return growth, I've already put some money in the market, so I did not miss out completely. But if the market is going to do a tumble going downwards again, I still have 75% of cash holdings to invest. So right now, I'm in the middle, so I have some money deployed in the market. I also have some cash reserves holding just in case the market turns for the worst and I can purchase some stocks at a discount. Right now, I recommend for you to take a look at your personal feelings about money and also learn from professionals. You can just Google some big names out there that are famous in investing and see what they're doing with their portfolio and their companies. In conclusion, pick out companies that you personally enjoy, and right now you still haven't missed out on any of the potential gain. There's still time to get invested, but don't invest 100% of your cash holdings because nobody can predict the future. What if the market drops again next month or next 6 months? And at that time, you wish you save some of your cash in order to have invested. So whatever percentage you are comfortable with. For me, it was 25%, and companies like Berkshire Hathaway with Warren Buffett, they have billions of dollars and they're still waiting around. In the first quarter, with the common stocks that they own, they have lost almost $50 billion worth of common stocks value. So however much you and I have lost, I can almost guarantee that it probably wasn't as close to 50 billion. So if he's still waiting around to make an acquisition, even having lost that much money, you and I, we can still be patient with our own holdings. It doesn't feel good to look at your portfolio and see red after red, or that the gains you have developed in the past several years wiped out in a month or two. But stay strong and pick out stocks that you personally enjoy. The volatility index that I talked about earlier is a measure of how fast the market can go up or drop. In March, the volatility index was over 90. And what does that number mean? In comparison, let's take a look at what happened in 2008 recession. Back then, the volatility index was also in the 80s, almost approaching 90, and then dropped. Right now, it's still in the 30s. And for me, that's still too volatile of a market to make a conclusive decision that we're in the green. Because to be in the green, we have to beat the coronavirus, and there's no conclusive evidence that any company has developed a guaranteed vaccine or cure. It might happen next year or so. Until then, there still could be a resurgence of this coronavirus in the fall. No one can predict the future, so if that's the case, have a little bit of a cushion of cash reserve before you invest everything. Thank you so much for watching and supporting this channel. If you like this video, give me a thumbs up, subscribe, and click on the notification bell so you don't miss another video. Thank you so much, and have a wonderful day.